Chinese property developer Evergrande missed another US dollar debt payment last week without giving any signals on if they intend to pay up. I think it's safe to say they're more concerned with taking care of their domestic situation than helping out international financial markets. Today, we're going to take a deeper dive into how the US real estate market might feel the effects of an Evergrande collapse and downturn in Chinese real estate, looking specifically at the major California markets that could have the most exposure to any contagion coming out of the situation. Let's get into it. The signs of China Evergrande's collapse are mounting as they missed another interest payment on debt denominated in US dollars, the second in 2 weeks. Given that they are working with their domestic lenders yet are silent on the lack of payment to international lenders is telling, to say the least. We're also seeing signs that this is spreading beyond Evergrande as another Chinese property developer failed to make a scheduled debt payment this Monday. In our last video on Evergrande, we looked at how the collapse of the Chinese property developer might affect the US real estate market. We focused primarily on the exposure US markets had to Chinese ownership, given that a liquidity crisis in China might force owners to sell their US real estate holdings to boost their cash position. In our analysis, we found the California markets had the most exposure to Chinese ownership, so we'll be focusing on those in today's video, specifically the San Francisco Bay Area. We're going to look at the supply and demand dynamics to assess the health of the region's market. We'll be looking at the Southern California markets in an upcoming video. Now, I should note that 2 of the 3 major Bay Area markets we'll be looking at, San Jose and Oakland, are on our top 20 list of markets to watch for signs of an impending real estate crash. So, today's video also contributes to our ongoing series on when is the housing market going to crash. Be sure to check out those videos as well to follow how we're looking at real estate across the US. I'll leave links to them in the description down below. Now, let's start with prices. The median price for a home in the 3 largest Bay Area markets has marched steadily higher over the last 5 years, with double-digit growth rates reached in most of them. The Oakland metropolitan area saw price growth as high as 31% year over year in May 2021, according to data by Redfin, a national real estate brokerage, although it has cooled off to only 14% year over year in August. The San Jose area saw a pandemic high of 22% back in January 2021 and hit 20% in June as well, before settling down to just 11% in August. San Francisco has struggled a bit more and fared the worst of the 3 in recent years due to affordability issues that were already in place before the pandemic, and during the pandemic there's been the lure of working from home in a more affordable area that has sapped demand in local San Francisco markets. Nevertheless, growth did reach over 8% year over year in April and July of 2021. Now, overall, we're seeing a bit of a softening in price growth in these markets. The question is this coming from the supply side or the demand side? And could this be a sign of trouble to come as a result of fallout from the Evergrande crisis? Let's look at the supply side and see if we can shed some light on this recent softening of price growth through August. Looking at new listings in Bay Area markets, they're holding above pre-pandemic averages. They have slipped a bit from their pandemic highs, especially in San Francisco, but are still well above where they were before March of 2020. On the demand side of things, the pace of purchases has slowed somewhat in all 3 markets from their recent highs, which has resulted in a slight uptick in inventories. This month's supply of homes, however, is still in record low territory, suggesting a steep drop in prices is not likely outside of a major shock to the markets. So to sum it up, prices have pulled back in the Bay Area, and it seems to be as a result of a marginal pullback in demand, given that supply is still running relatively strong. The prices we looked at are seasonally adjusted, so it's not due to the historical weak real estate season of the year we are entering. What is most likely is that we're seeing affordability issues at work. Prices can only go up so high before no one can afford to buy what's on the market. We gave a heads up on this softening in the market due to affordability in a recent video just a few weeks ago. With respect to the Evergrande situation developing in China, it seems to be too early to see if that is having an effect here in the U.S. markets. While we did get news of potential defaults on debt payment more than a month ago, the real estate data we're working with is only through August. In a few weeks, we'll start seeing new market data for September coming out, and we can provide an update on the situation at that time. Given that the overall market appears to be softening, however, if there were spillover from the Evergrande default into the U.S. housing market, it would have more of a significant impact than if we were still seeing upward momentum in U.S. housing markets. If you found this episode useful, please give it a thumbs up to support the channel, and make sure you're subscribed and hit that notification bell down below so you know right away when our next video on the topic is released. If you're watching this on our Real Estate Watch channel, don't forget to check out our main channel, PapayaCast, where we cover much more of the overall economy than we do here. Thanks for stopping by, and I'll see you in the next video.